Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, look at what's going on in the Twitter space, what people are talking about, what kind of news. I'm going to obviously give a bunch of my financial opinions alongside it. It's really just basically getting a pulse on what's going on in the markets and what people are thinking and talk about. I don't really use too much news-related stuff for my investments. I'm really more focused on ratios, which determines the market conditions. Market conditions is what prices assets or directs or redirects money flows in the market. So when we see different assets outperforming other assets, it basically describes the market conditions that we're in or going to encounter, depending on what kind of patterns, what kind of bottoming patterns or shifts that are happening in the markets with ratios. But let's dive in here. Again, if you want to follow me, it's at finding_finance. I also have a website, finding-value.com. If you guys need any help with the markets, finding potential investments, I've got a lot of training videos on there as well for technical analysis, ratios, market conditions, and the cycles of different commodities and stuff like that. So let's go through Kevin Bamborough. I think he's got a pretty good opinion based off of a lot of the things that I've listened to from him. So we're going to share some of this. It says, and we shall have a full-blown recession in the USA in the next couple of years that will have people forecasting 4 trillion plus of deficits. The Ponzi economy with Ponzi currency, and for your information, crypto won't save up. It's worse than fiat. People must acquire fiat to pay taxes. It says they will bail this and bail that, print a few $100 billion here and guarantee a few $100 billion there. They will also get back to QE in a huge way because they must make sure that the 2 trillion plus budget deficit is funded with new Treasury bill issuance. I agree with all that. Fed speakers, and this is kind of crazy that they did this. The Fed speakers came out and they said no recession. The Fed staff came out directly after and said recession. Same day, you can't make this up. It says Fed staff projected a mild recession starting later in 2023. Coming up here, yeah, and there will most likely be no recession, which was right before they came out and said that there's going to be a mild recession starting in 2023. Now, here's Michael Gayed. He says, deflation is the risk when you have 300 trillion of global debt. Debt becomes deflationary when you can't issue more of it. The only problem I have with the deflation camp is, where have we seen this gigantic deflation, and how long has it been? How persistent has it been? What I've seen is your demographic is really what's driving deflation or inflation. You have to loan the money into existence, and if you have a larger demographic coming into home buying years taking more loans out, well, that's going to be inflationary. If you've got a declining population or demographic, then you've got less loans, less credit expansion, less everything, and sometimes it even contracts. That is when you have a problem. Japan went through that. It was demographic driven, and that demographic interacting with the housing market caused a deflationary or disinflationary period for a very long time. That's the way that I view it. But every time you get a deflation problem, they won't let it persist. They're going to pump it with more inflation. Why? Because it will collapse on itself. You can't go through a prolonged period of massive deflation. Your tax revenues collapse, and your tax revenues on all fronts, state, federal, revenues for property taxes. It goes on and on and on and on. It goes down, and the design of the system can't handle that. At least that's my opinion on it. Here's one, Tommy Deepwater. He says, still love rig for deepwater recovery. Very interesting plays on the Guyana offshore with big upside. This is where the growth is. Seadrills has been all over Frontera, CGX for good reason, deserves attention. And this is the deep water discoveries that they've got, and they're just basically poking holes everywhere off of Namibia. It says, in a highly financialized economy, if asset prices don't keep up, tax revenue tends to stagnate and the deficit widens. I totally agree here. And what you're going to see is if you have a declining stock market, declining property prices, declining anything, your tax revenues go down and your deficits will start to explode. So this is probably what we're going to see going forward. It says the 2023 deficit is exploding. For the first 3 months of 2023, the deficit has a whopping $679 billion, an increase of 134% over quarter one of 2022, which is $291 billion. Receipts, about $1 billion versus a little bit over $1 billion. And then our outliers are 1.7 versus 1.3. Lower revenue and higher spending. And this is our calendar year deficit. You can see this taken off in 2023, and you can see 2022 here. So you have to look at this from kind of a bigger picture view. You can't get too far into the weeds. If you kind of just take a big picture view at everything, they need inflation to increase their tax revenues as well. They need the stock market to go up. They need tax revenues to increase if they want to sustain this system. If they don't get tax revenues to go up and you get a recession, we could get some pretty bad, a stagflation where you get inflation and a recession simultaneously. And where you want to look at for that, in my opinion, is the shortages of commodities. If you see, we'll say, pretty decent sized shortages across a good number of commodities, that means pricing of commodities, especially oil, natural gas, and the energy sectors, if they continue to go higher, I think we're going to get some sort of weird stagflationary environment for a period of time. And if we get that stagflationary environment like the 1970s were, which was demographic driven, just like the demographics align here with the millennials coming into home buying years. Back then it was baby boomers. If we get that type of alignment, we could see deficits explode, which could also be inflationary. And that inflation is, I think, going to drive up precious metals prices, given that stagflationary environment, much like the 1970s. Here's JC. It says, the silver train has left the station. Fed minutes acknowledging a recession is coming. Daly and other Fed speakers are getting more dovish, yet core inflation remains elevated. Meanwhile, a massive silver shortage is rapidly emerging. Goldilocks. Here's Holger. Gotta love Holger. It says, U.S. two-year yields tumble by 14 basis points to 3.88, following softer U.S. inflation data, reflecting expectations for rate cuts down the line. But the probability for a 25 basis point rate hike in May remains at 75%. So what I'm looking for, and we want to know this because this is basically the cycle, guys. The cycle goes from a basing period, which is a recovery phase. So we go through a recovery phase. We go into a inflationary or hyperinflation, not hyperinflation, but a hyper supply phase where we build more homes, gets inflationary. And this isn't necessarily all driven by homes. There's a lot of stimulus thrown behind this. We peak out and then we come back down. As we come back down, that's a different market condition. Certain investments are going to work from 2020 on to about 2022. And then when this reverses back down and we saw that banking crisis and the steep selling pressures, or I should say buying pressures in bond prices, that's the way yields falling here. It's signaling that a different market condition could be coming. That different market condition has different investments that work. So this works very well for a uranium, oil, energy, like that type of environment. When this comes back down, generally speaking, historically based, gold and silver do very well. That doesn't mean that when this comes back down, that oil cannot go higher or uranium cannot go higher. It just says historically, when this goes down, we've got declining inflation and potentially a slowdown in the markets. But the problem is that's generally driven by credit. So this is credit expansion. And then on the downside, this is credit contraction or a slowdown of credit expansion. But the problem is, or what's different here, and I'm not saying this time's different, I'm saying, but we could have different conditions, is that the supply side of commodities is pretty jacked up. And we're eating through inventories. So if supply of some of these commodities outpaces the credit slowdown, we could still see prices increase. And that's where it gets funky, because almost all of the other instances in history have been credit expansion and credit deceleration and eventually credit destruction in these markets. We have not seen a supply problem like I think we are going to see ever in anyone's lifetime. The closest we've come to is the early 1970s when we hit peak oil just in America. This is going to be worldwide. So we could see some really funky looking stuff that people have never seen in the markets before, where maybe it's even possible, I don't know, where we see this decline of interest rates at the same time that we still see commodities go up, at least some commodities. And that's really what I'm trying to figure out is that possible? Because we haven't really seen that in history too much. It says fuel economy standards were implemented in 1975 in response to the Arab oil embargo. That's that problem that we had in the 1970s in America. So since most batteries, materials, rare earth supply chains are controlled by China, EPA is mandating that U.S. energy security be completely reliant on China by no later than 2035. Go figure. And this is the key minerals in an EV battery: graphite, aluminum, nickel, copper, steel, manganese, cobalt. And these are all the ones that have pretty tight inventory balances. There's going to be a bunch of problems in these exact metals. I'm not exactly sure what they're doing with these mandates, because if everything is processed over in China, which is like 99%, I don't know how that's going to work if they don't comply or don't want to comply. Yeah, I do think that's interesting. Here's Grady. He always has great insights on stuff and great charts. It says gold has broken out versus SPX on a 3-year chart. This is a 14-year chart. Generational breakout. This gold breakout versus SPX, which is the S&P 500, while the S&P 500 versus the producer price index is backtesting from below, is a beauty. It's a historical paradigm shift in the making. US CPI and PPI this week. So what he means by this is we've got a declining wedge, and this one is an increasing megaphone. What you want to see from technical analysis is you want to see a breakout, and then you'll probably get a retest backtest. What this means is that the trend that has occurred from 2011 all the way to 2022 is done. So this downtrend's done, and we're probably going to see gold outperform the S&P 500 or stocks. That's what this chart is basically signaling. And we want to see confluence of information. Confluence is the lining up or alignment of a bunch of different charts that support a thesis or helps develop a thesis of someone's. So if someone's going to say we're going to go into a gigantic gold bull market, into a gigantic commodity bull market, we would see gold start to outperform stocks just like we're seeing here. We would also see the producer price index outperform stocks as well, which we're also seeing. It's a breakout, a back test, and then this is going to come back down at some point. What this is basically telling us is that we are breaking. This here is your business cycle, and we are breaking into a different portion of that business cycle. The business cycle here is the expansion phase of real estate or an inflationary time frame. I know a lot of people think that real estate is going to go down, and it doesn't matter what they think, it matters what actually happens. But generally speaking, looking at history, the business cycle's been driven by real estate. And real estate has a lot of jobs and employment, all these things tied around it. Demographics are larger during those time frames. The demographics bigger coming into home buying years. There's a bunch of different reasons of why that business cycle happens. But this is telling us that there's a change and that we could see commodities and gold and all these things outperform for a decade plus. Now here's silver. This is more evidence of basically this right here. All these charts are just evidence of a commodity bull market and precious metals bull market coming. So what happens is we develop these gigantic flag patterns and these big consolidation patterns, and you go up in what's called a stair-stepping pattern. You have these impulse moves higher, and then it stair steps. So this is one big step, and this is your impulse move higher. Then you're going to get another impulse move higher. Right now, if you were to look at those market conditions that I was talking about earlier, so I'll just read this and I'll go into it. So silver's breaking through the last line of defense, and soon bulls should be in full charge. Looks like it's just a matter of time when the silver miners finally explode. So we get these stair-stepping patterns, and silver does very well when there's fear in the market and things are slowing down from an inflationary boom. And that's really what aligns what we have with these interest rates. The inflationary boom and then the slowdown as it comes back down. This is when gold does very, very well. That's when money starts to flow into precious metals, and we can see that in all these different charts. Here's another one, silver. Who remembers what I said 2 years ago? So it's all noise until we pass through zone 1 or zone 2. Nothing has changed. The chart was correct. It will continue to be correct. So this is silver, the weight of evidence. You can see on the left-hand side this gigantic impulse move higher. That's all this back here. It's a big impulse move. And this here is one big consolidation area from 2011 all the way over to about 2020. So the bottom of 2020, this is the bottom down here. That's the bottom. We created an impulse move higher, a flag pattern that's created, and then we're going to hopefully break to the upside here, this resistance line. If we break that, you'll probably see a move up to about $27, $28, and we have to break through that as well. It may take time. It may not just go straight higher up to $50. It may break and consolidate in that stair-stepping pattern that I described. But I would guess that we could get a pretty big move even up to $42 or $50 is definitely possible. If we break this, that has broken momentum on longer time frames. So a lot of people, they look at the small time frames. You want an alignment of every single time frame, a long time frame, a medium time frame, and a short time frame, to all align and give you a gigantic big buy signal where it does well in the short term, the medium term, and the long term. That's your lowest risk, highest reward entry points. It also means that the market conditions are the ripest on multiple timeframes or cycles. And I think that's aligning for multiple timeframes on multiple cycles to move higher here for precious metals. You could get an alignment like the 1970s, way back in the 70s, where we just get a gigantic move higher. I don't think the 2000 to 2011 bull market in gold was a big bull market. I think what's coming is going to be a big boy, and it deals with longer term cycles. Tavi obviously says silver's on the brink of a major breakout from a 12-year resistance, a historically undervalued monetary asset with strong inflation hedging attributes, facing material supply constraints and now becoming increasingly crucial to the green revolution. Silver is the number 2 commodity in terms of its uses. Oil is number 1. And silver here looks like it's ready to break out. What this is also telling us, if you can look, you can see a low in 2008-9. You can see a higher movement in 2016, a higher movement in 2019. The closing here is still higher in 2020, and then a higher one in 2022. And we're continuing to make higher highs as we come up into this resistance area or resistance trend line. When we break through that, it's game on, baby. It's game on. And I think it already is game on, given the momentum and the way that the ratios are breaking out against each other. Yeah, I did do a video with Patrick. So thanks, Patrick. Lance says, house prices in most markets have already bottomed out, says CoreLogic chief economist. That's just another opinion there. And this is what I was talking about, that gold movement. It says the inflationary 1970s caused a huge rise in gold. When called the commodities bear market low back in April of 2020, also said we're in for big inflation. I think it's time for the next historical inflationary wave and the second massive up leg in gold. So when money gets printed, the first thing that happens here, I'm going to back out. This is a little bit too big of a chart. The first thing that happens here is gold and silver respond to that monetary creation of money. So that rockets higher first. We saw that in the 2008 to 2011. We saw it in 2020 as well when they created all that money. That money may be created for QE. It may be created for deficits spending that they're doing because of the interest rates and the lower tax revenues, et cetera, et cetera. If they print the money, gold is the first one to react. We are seeing gold react right now. So that means that they're bailing out banks. They're creating hundreds of billions of dollars, which they did. Their bank balance sheet increased by $300-something billion, maybe even $400 billion. And then it's probably going to lead to even more money printing. This here is going to account for that, and it's going to run first. Then what comes after, generally speaking, is oil and uranium and other investments. So that's the next move 6 to 12 months after gold moves. It'd be nice to ride gold higher. Hopefully that really takes off. And then you can rotate into oil and uranium before they go. That's the ideal entry points. Yeah, and that's what I've got for today, guys. So if you need help on any of that stuff, definitely sign up to the website, finding-value.com. Become a platinum member. You can use the word discount in the coupon code. And I go over all these different charts. You can see in how they're working against each other and the ratios changing, the different market conditions. And obviously, I chart a lot of stuff that people ask me to chart. And then I give my opinions along with a lot of the stocks that we look at. You can see my portfolio. You can see exactly what I own. I have a post that I update all the time on what I'm buying, when I'm buying it, and the prices I'm buying at. So you can see my moves and you can see my performance. You'd have to aggregate it together. I don't say how much I'm buying. I just tell you what I'm buying. But yeah, you can see all that. Pretty transparent. But that's what I've got for today, guys. Hopefully you guys are killing it in the markets. Give me a thumb up for the content. Subscribe to the channel. And we'll catch you next time. This is Finding Value.